Now, carrying around a lot of money is difficult, so we don't always do that. And what we used to do is use these pieces of paper here, which a lot of you won't recognize, but some of you will, and they're called checks. And checks are kind of interesting because checks aren't money. People don't have to take checks. One of the reasons, so what a check is it's a note that you're writing, and you're handing it to a person which will instruct their bank to take money from your bank account. And people don't have to take checks because checks aren't legal tender. And there's another reason why people don't take checks is that you might not have the money in your account. And also, checks don't actually represent cash in the sense that I talked about earlier, and that checks aren't issued by the government. They're not liabilities of the central bank. They're liabilities of the bank that issues them. All right, so they're not quite the same thing as money. Well, anyway, after a while we evolved, and we started getting digital forms of money. So we got debit cards and we got credit cards. And these things are really useful, right? Because now we don't have to carry around cash and we don't have to worry about paper checks. And then eventually we got something else called PayPal. And I imagine a lot of you have used PayPal. And PayPal is really neat because it basically allows you to make transactions, not to stores that have card readers, but it allows you to make payments to your friends, right? PayPal allows these person-to-person transactions to take place. Then a little later, we also got something called Venmo. Venmo is very popular in California, all right? And Venmo doesn't work like PayPal. PayPal actually is built off of your credit card. Venmo is an actual instant payment. It works off of cash that you've sent to the Venmo company and allows you to make these instant payments. So Venmo is very, very convenient. And then we also have these other things, Apple Pay, Android Pay, Google Pay. And what these things are doing is that these things are just a slightly different way to pay with a credit card in a way that protects your identity from the person that you're purchasing something from. And that's very important.
Give me the pros first for central banking getting into cryptocurrency of some kind.
At one level, it's going to mean that central banks remain in the game. If you look at certain economies like Sweden, where the use of cash is very fast disappearing, central banks may have very little role to play both in terms of wholesale as well as retail payment systems. So this would keep central banks in the business of creating money, although most money in modern economies is really created by commercial rather than central banks. In addition, having a central bank digital currency would put a crimp on illegal activity that is intermediated to cash, bring a lot more activities into the tax net, and it would also make monetary policy at one level somewhat easier to implement. If we all had deposit accounts with the Federal Reserve, which would be one way of having electronic money, the Fed would be able to impose negative nominal interest rates, which it couldn't do during the financial crisis. So there is a lot to be said for
obvious, but outline with some
none other than outgoing Bank of England Governor Mark Carney himself. He spoke those very interesting words about the potential of a central bank-backed cryptocurrency or digital asset, or something he called synthetic hegemony currency, essentially a global reserve currency backed by many instead of one. What did he mean by that? As a trained economist at one of the largest financial institutions in the world, and to have a central banker like the Bank of England governor coming out to say that potentially we need a multiple backed digital asset in the global economy. These are pretty heavy words.
Extremely heavy. I mean, just to try and put it in context for viewers, it's kind of like going to a Jewish wedding and asking for a pork chop. It's, you know, it's just not really the done thing, particularly when it's at a central banking conflab organized by the US on US territory. So you turn up
That's
there
right.
and you give a speech basically saying, guys, you know, the US dollar, you've had your day in the sun. We think we should replace you with something else. It's quite remarkable. And in fact, even
islands and the Caribbean central banks and the Bahamas, actually. You have, I believe, 4 or 5 islands which together have decided at central bank level to go with a digital currency. So central bank digital currency is coming alive. It's not going to happen today. I think they have a 12-month experimental period that they want to go through before they actually launch for good.
How much at the IMF are you thinking about?
Understanding Central Bank Digital Currencies, CBDC. Today let's look at what Ripple XRP they are doing with Central Bank Digital Currency CBDC. Ripple connects banks, payment providers and digital asset exchanges via RippleNet to provide one frictionless experience to send money globally. Banks and payment providers can use the digital asset XRP to further reduce their costs and access new markets. XRP is the fastest and most scalable digital asset today. Central Bank Digital Currency, CBDC, also called digital fiat currency or digital-based money, is the digital form of fiat money, a currency established as money by government regulation, monetary authority or law. According to a recent study conducted by the Bank for International Settlements, more than 70% of institutions are actively researching and developing proofs of concept for CBDCs. CBDC is managed on a digital ledger, which can be a blockchain or not, expediting and increasing the security of payments between banks, institutions, and individuals. The benefits of CBDC. CBDC solves the inefficiencies and vulnerabilities in our current central banking infrastructure by simplifying the creation of a secure payment system that serves as a large-scale, decentralized clearinghouse and asset register. Benefits of retail CBDC. It increases availability. It streamlines reconciliation. It fosters digital innovation. It enhances monetary policy. It improves interbank payment settlement. It reduced counterparty risk.